Hello! In this video, I will be showing you the first 3 steps in the accounting cycle of a merchandising business. That would be journalizing, posting, and the trial balance. I will be also preparing the cycle or the steps using the periodic and the perpetual inventory system. And then I will be using the problem will be taken from the book of Balyada Basic Financial Accounting and Reporting, problem number 23. So, this is the problem. And then it started with the opening balance for February 1, 2020. So, first, what we will do is we're going to post, since we'll be using this problem for the entire cycle. So, we'll be posting first the beginning balances. So, post this to the respective day account. So, here, I am preparing already the day account. So, I'll just show you later. So, after posting, we now prepare the journal entries. So, let's start. On February 1, 2020, the first transaction is collected. Oh my God. Come on. Hi everyone. In this video, I will be showing you the first 3 steps in the accounting cycle of a merchandising business. I will be also using the periodic and the perpetual inventory system. The problem will be taken from the book of Balyada, Basic Financial Accounting and Reporting, problem number 23. Okay, so the problem started with the opening balances for February 1, 2020. So what we will do is we will post these balances or the opening balances to their respective account. So I have it posted already here. I will just show you later. So I will just start with journalizing or the journal entry. So first transaction February 1 collected 113,000 from customers' account. So what would be our journal entry? So for February 1, this is our journal entry with debit cash 113,000 and credit accounts receivable 113,000. Explanation to record collection. So this is for periodic inventory system. For the perpetual inventory system, we still have the same journal entry. We debit cash 113,000 and with credit accounts receivable 113,000. Next transaction, February 2, paid 64,000 of accounts due, less discounts of 3%. So, we need to compute for the payment. So, how do we compute for I was not able to compute this one. So, how do we compute for the discounts? So, I was not able to show the formula. So, how do we compute for the discounts? So, we have 64,000 is the base price. So, we can avail of a 3% discount. So, what we will do is 64,000 times 3%. So, our purchase discount is 1,920. So, the only cash or amount of cash that we paid is 62,080. That's 64,000 minus 1,920. So, our entry is debit accounts payable, 64,000. Credit cash for the net amount, that's 62,080. And then credit purchase discounts, 1,980. So this is our entry for the periodic inventory system. For the perpetual inventory system, there is a difference because instead of recognizing purchase discounts, we directly charge it to or credit it to the merchandise inventory account. So our entry is debit, accounts payable 64,000, credit cash 62,080, and credit merchandise inventory 1,920. Okay, then we proceed to Transaction February 4. Purchased merchandise 170,000. Terms FOB shipping point 310 and 30. So under the periodic inventory system, this is our entry. We debit purchases 170,000. We credit accounts payable 170,000. To record purchase of merchandise terms FOB shipping point 310 and 30. Under the perpetual inventory system, it's different because our debit is merchandise inventory. So we debit merchandise inventory 170,000. We credit accounts payable 170,000. So what differs is the account that we were going to debit. For the periodic inventory system, we debit purchases, while in the perpetual inventory system, we debit merchandise inventory. Next, February 5, sold merchandise on account to Gonzales Incorporated, 270,000 terms FOB shipping point, 210 and 30. So our entry for the sale under the periodic inventory system is debit accounts receivable Gonzales Inc. 270,000 and credit sales 270,000. So this is our explanation. And then for the perpetual inventory system for February 5, we need to prepare two journal entries. And that would be our entry to recognize the sale. So we have the same entry just like the periodic inventory system. So we debit accounts receivable 270, we credit sales 270. And then at the same time, we will recognize our cost of sales. So our entry is a debit to cost of sales. So we just assume that since there is no given gross profit rate in the problem, so I just assume that it's 120% of cost. So that's why I divided 270,000 by 120%. So the cost is 225,000. Then we credit merchandise inventory 225,000. Okay. Then our next transaction, February 7, paid for advertising for the month of February 6,000. So under the periodic inventory system, we debit advertising expense 6,000, we credit cash 6,000. Under the perpetual inventory system, we have the same journal entry. So it's a debit to advertising expense and a credit to cash 6,000. Then we have another entry for another transaction for February 7, sold merchandise for cash 250,000. So our entry under the periodic inventory system, we have debit cash 250,000 and credit sales 250,000. Then for the perpetual inventory system, again we have an entry to record for cost of sales. So I assume again that's 120%. So debit cash for the sale, no debit cash 250,000 and credit sales 250,000. And then for the cost of sales, we just divide 250,000 by 120% or 1.2. So we have cost of sales 208,333.33 and we credit merchandise inventory of 208,333.33. Next transaction, February 8. Paid the amount due from the February 4 transactions. So this is a transaction coming from February 4. If you're going to recall, our February 4 transaction is 170,000 with 3% discount when paid within 10 days. If you're going to count it is still under the the discount period. So the company can still avail the discount. So our computation for this one is we have accounts payable of 170,000 less the purchase discount of 170 times 3%, that's 51. So the amount to be paid is 164,900. So to make the journal entry, so this is our debit, accounts payable 170,000. Our credit is cash 164,900, the net amount, this one. And then our purchase discounts of 5,100. Okay. And then under the perpetual inventory system, we have the same journal entry. So we debit accounts payable 170,000, then we credit cash 164,900, then we credit merchandise inventory. Okay, this is now different because under the periodic inventory system, we credit purchase discounts, but under the perpetual inventory system, we credit directly the merchandise inventory. That's 5,100. Then we have next February 9, paid Iloilo Freight 4,000 for delivering merchandise last February 4. So our entry for the periodic inventory system, so we have transportation in 4,000, then we have cash 4,000. Under the perpetual inventory system, we don't recognize it as a transportation in, but it's an addition to our merchandise inventory. So we debit merchandise inventory 4,000 and credit cash 4,000. Then we have February 10, receive returns from Gonzales Incorporated 70,000. So this is a sales return. So to record, under the periodic inventory system, we have sales returns and allowances 70,000, credit accounts receivable in Gonzales Inc. 70,000. Under the perpetual inventory system, we have the same journal entry. So debit sales returns and allowances 70, then credit accounts receivable Gonzales Incorporated 70. Then we have another entry to recognize our inventory and a reduction in our cost of sales. So how do we compute this one? Again, all throughout, we assume 120% gross profit rate. So to get the cost portion, we divide 70,000, that's the selling price, by 120%. So that is 58,333.33. So our entry is debit merchandise inventory 58,333.33 and credit cost of sales 58,333.33. Then we have February 12, receive payment from the Gonzales Incorporated less returns and discounts. So we need to have a computation. This is for February 12. Okay. So our transaction from Gonzales is on February 5, which is 270,000. And then we received 70,000 on February 10 as returns. That is why the balance is only 200,000. So 200,000 less a 2% discount. So the net amount that we collected is 196,000. So our entry is debit cash 496,000. Then we debit sales discounts, 4,000. Then credit accounts receivable for the balance, that's 200,000. Okay, and then for the perpetual inventory system, so we have debit cash, 196, sales discounts, 4,000, accounts receivable, 200,000. So the same entry with the periodic inventory system. Okay, then we have February 14, paid 26,000, interest on the mortgage payable. So our entry for this one is debit, that's 14. Interest expense, 26,000. Credit cash, 26,000. Then we have the same entry for the perpetual inventory system. Okay, next transaction, paid salaries, 51,000. Okay, so what's our entry? Under the periodic inventory system, February 15, we debit salaries expense, 51,000. Credit cash, 51,000. And then for the perpetual inventory system, we have the same journal entry. So we debit cash, 51,000. Rather, we debit salaries expense, 51,000. Credit cash, 51,000. Then we have February 16, sold merchandise on account to Ronsales Corporation, 392,000. Terms, FOB destination, 210 and 30. Under the periodic inventory system, we debit accounts receivable, Ronsales Corporation, 392,000. Credit sales, 392,000. Under the perpetual inventory system, again, we have two entries. One to recognize sales, so we have the same entry for periodic. And then the next one is the cost of sales. So again, I'm assuming it's 120% based on cost. So 392 divided by 120%, so cost of sales is 326, 666.67. Then we credit merchandise inventory, 326, 666.67. Then we have 18, paid 4,000 freight charges on the sale of February 16. So this is a freight out or a transportation out. So under the periodic inventory system, we have a debit to transportation out and credit cash, 4,000. By the way, I'm using the account titles provided in the problem. And then for 18, under the perpetual inventory system, we have the same entry. Then February 19, acquired supplies for cash, 21,000. So under the periodic inventory system, we debit supplies, we credit cash, 21,000. Then for perpetual inventory system, they have the same journal entry, debit supplies, 21,000. Credit cash, 21,000. Then we have 20, purchase 125,000 of merchandise from Lazada imports on account. Terms, FOB destination, 310 and 30. So under the periodic inventory system, we debit purchases, 125,000, and credit accounts payable, Lazada imports, 125,000. And then for the perpetual inventory system, we debit inventory or merchandise inventory, 125, and credit accounts payable, 125,000. And then 22, paid 7,000 miscellaneous expenses. So under the periodic inventory system, we debit miscellaneous expense, 7,000. We credit cash, 7,000. We have the same entry for perpetual inventory system. Then we have 23, receive payment from Ronsales Corporation less discount. So how do we compute for the discount? Our transaction from Ronsales is 392,000, then 2% discounts. So we have 392 times or less 2% discount. So that would be 392 times 2%. It's 7,840,000. So our, sorry, this is 384,160. 384,160. So the net amount to be collected is 384,160. So the journal entry is debit cash 384,160. Then we credit sales discount 7,840 and credit accounts receivable 392,000. And then under the perpetual inventory system, we have the same journal entry. Okay, then we have 24. Purchase 373,000 of merchandise on account from Agustin Enterprises. Terms FOB shipping point 310 and 30. So under the periodic inventory system, we debit purchases 373,000. We credit accounts payable. Lusada imports 373,000. And then for perpetual inventory system, we have debit merchandise inventory 373,000. Credit accounts payable. Lusada imports 373,000. Okay, the same date, we have paid La Paz Express 9,000 freight for delivering merchandise acquired from Agustin. So this is freight in. But in our case, we'll be using the account title transportation in. So for the periodic inventory system, we debit transportation in 9,000, we credit cash 9,000. Under the periodic and rather the perpetual inventory system, we debit directly merchandise inventory 9,000, then credit cash 9,000. Then we have 25 sold merchandise to Ronsales Corporation on account 420,000 terms FOB shipping point 210 and 30. So under the periodic inventory system, we debit accounts receivable Ronsales Corporation 420,000, we credit sales 420,000. For the perpetual inventory systems, we have two entries. One entry to recognize sale, which is the same entry with the periodic inventory, while the second one is cost of sales. So again, I'm assuming 120% markup. So 420 divided by 120%, it's 350. So we debit cost of sales, 350. We credit merchandise inventory, 350. Then we have received returns from Ronsales Corporation, 71,000. So for 26, our entry is debit sales returns, 71,000 credit accounts receivable, Ronsales Corporation, 71,000. That is for periodic inventory system. For perpetual inventory system, again, we have two entries. One entry to recognize the return, let's say the decrease in AR, or reduction in AR, and the recognition of the sales returns. So it's 71,000. Then another entry to recognize the merchandise received. So it's a debit to merchandise, 71,000 divided by 120%. So it's 59,166.67. Then credit cost of sales, 59,166.67. Then we have February 28, Buena Flor withdrew 400,000 from the business. So under the periodic inventory system, we debit Buena Flor withdrawals 400,000, we credit cash 400,000. And then under the perpetual inventory system, we have the same entry. And last transaction, return merchandise purchase from Agustin on June 24, 25,000. So under the periodic inventory system, we debit accounts payable 25,000, and then we credit purchase returns and allowances 25,000. And then for the perpetual inventory system, we have a debit to instead of crediting purchase returns and allowances, we credit merchandise inventory. Okay, so debit accounts payable 25,000, then credit merchandise inventory 25,000. Okay, so that's the difference between the perpetual and the periodic inventory system. Okay, so after this, we'll now be preparing the posting. Okay, so this is ready. So to post, you just have to follow each of the, do it chronologically, so post it chronologically. So we start with cash. So I just highlight this one. So cash, we have 113,000. This is February 1. So I'll just highlight those accounts that were already posted. Okay, so and then we have accounts receivable, 113,000. So credit. So credit, post it also on the credit side. And then we have next is accounts payable, 64,000. So proceed to your accounts payable, the account. So we have accounts payable 64,000. This one. Then we credit cash. Okay. Credit cash February 2. So this one, 62,080. Then after that, we'll have purchases. So proceed to your purchases account to make sure, so just highlight it to make sure that I'm already done with the account. So you have purchases, debit 170,000, February 4. So look for the purchases account, February 4, 170,000. Okay. Then we have accounts payable. So proceed to your accounts payable. This is February 4, accounts payable, 170,000. So this one, 170,000, February 4. Then after that, we have accounts receivable. So proceed to your accounts receivable debit. This is February 5. So you have it here, February 5. Then you credit sales, post sales. So we have proceed to your sales account. That is February 5, 270. Sales. That's February 5, 270. Okay. Then we have advertising expense. So proceed to your advertising expense account. That's February 7, 6,000. Advertising, February 7, 6,000. Okay, so you have it here. Then after that, we have cash. So proceed to your cash account. You have it here. A credit of 6,000. Okay. So that is 6,000. Then next we have cash, another cash. This is a cash sale. So proceed to your cash as a debit. So debit cash, 250,000. Okay, so this is how you are going to post. You just do it chronologically, and then you just look for the account title where the journal entry should be posted. Okay, so assuming I have posted everything, okay, so I'll just take the highlights. Sorry. So assuming I have posted everything, after that, what I will do is foot the T accounts. So how do you foot add the total debit, and add the total credit. So for cash, the total debit is 976,160 and the total credit is 754,980. And then after that, get the balance. The balance should be posted on the amount or under the amount which has the higher amount. The higher amount. Okay, should be posted um on the side which has the higher amount. Okay, so since debit has a higher amount, so that siya i-post. Okay, dayon also put your AR. So total debit is 1,274 and total credit is 846. And then get the balances or the balance. Sorry, get the balance. So it's 428,000. Okay, so debit side. Then for the account titles which ano lang, which has one entry, I just leave it as is, no. And then for those account titles having two or more entries in just one side, so you just add it. So like this one is 72. Prepaid insurance, just leave it as is. Accounts payable foot, and then get the balance is of 517,000. Then as is, then add your sales returns. So sales 1,332,000. And then your sales returns and allowances is 141,000. Then also your sales discount, the total is, okay, let me highlight this one. The total is 11,000 for 840. And then for the purchases, the total is 668,000. Then as is total your transportation in is 13,000. Okay, then transportation out is 40,000. Just let me correct the spelling. And advertising, we have interest expense, and the last one is miscellaneous. Okay, so after getting all the balances, what you will do next is prepare the trial balance. So just copy the balances, observe, same debit, no, same credit. Supposing your account here has a debit balance, post it on the debit column of your trial balance. If it has a credit balance, then you post it on under the credit column of your trial balance. So let's start with cash. We have 221,180. So I have here periodic. So we have 221,180. So I'll just copy all the balances from there. So if it's a debit balance in your T account, then post it on the debit column of your trial balance. If it's a credit balance in your T account, then post it under the credit column of your trial balance. And after that, get the total. You should get an equal amount here. Okay? So you get na the balancing amount or the balancing figure. Now, there are cases where you cannot get the correct amount or the balancing amount. So, what you will do is you need to go back to your journal entries. You need to go back to your posting to check where did you get wrong. Okay. And then, so this is how your periodic inventory system unadjusted trial balance looks like. Okay. So, you'll have a total of 7,030,020. Okay, and then do the same in the perpetual inventory system. So after you have prepared all the journal entries, post it to your T account. Okay, so there's a difference in this one because under the perpetual inventory system, we no longer have the purchase account. Unlike the periodic inventory system we're in, we are using the purchases account the purchase returns and allowances and the purchase discounts and also with the transportation in. But under the perpetual inventory system, we no longer have purchases, we no longer have purchase returns and allowances, purchase discounts, and transportation in. But we have cost of sales account. Okay? So, when you prepare for the trial balance, you would notice nga, diferensya na sila. Okay? So, we no longer have these accounts here. The four accounts. But in here, naatay cost of sales. Okay? So, all the rest have the same account balances. You have the same cash. They will differ um, with their merchandise inventory account because under the periodic inventory system, your merchandise inventory account is 413,000, while the merchandise inventory under the perpetual inventory system is 69,480. All the amounts remains the same. Okay? So that's the difference between the periodic inventory system and the perpetual inventory system. Okay, so that's all. Thank you.